Today, we're going to talk about SoFi's recent earnings report and if I would buy, hold, or sell at these levels. SoFi knocked out of the park their recent quarterly earnings report here. I mean, blockbuster performance from any angle you look at it from. Just go to read this chart here. Earnings per share are up 120% year over year. Revenues up 38% year over year. And on the quarter, earnings per share is up 38% with revenue up 11%. It's becoming increasingly capital light business. Their lending is up around 10% on the quarter and 23% on the year. Their personal loan charge-off rates have declined by almost a full percentage point, signaling, strong consumers and conservative underwriting practices. Interesting here. It's funding 92% of all loans and financial products using just its deposit base. Overall, SoFi is executing flawlessly, and the business is well positioned to thrive in the future. The stock's probably a little ahead of itself, but I wouldn't recommend to sell right now. SoFi has been able to grow its members, and it's just going parabolic at this point. It's hard to really believe this growth. I mean, take a look at this chart, quarterly performance going back to 2019, and this chart is in millions, making its way from 700,000 to 12.6 million in 5 years. The growth is absurd. So I'm sure most of you have heard of the rule of 40. If you haven't, essentially the rule of 40 basically describes that if you look at revenue growth as a percentage, then you look at some profitability metric as a margin, their profit margin, and add those two together. If they're over 40, there's a very solid case to be made that this stock is going to grow and provide you with very nice returns in the future. So looking to SoFi here, their rule of 40 is a 67. Okay. It's been above 40 every single quarter since being a public company. The company just compounds and executes. It's very rare to see this. So SoFi recently also announced in their quarterly earnings that they're going to be launching a 5% cashback smart card. The CEO said that we will soon be launching the SoFi smart card and it will be a part of our SoFi Plus offering. The card will offer 5% back on food, which is the highest rate they offer. So here I have a chart plotted of total members and total products. Pardon me there. And it's exactly what you want to see. A slight uptick here in the products per member while memberships continue to grow rapidly. It's a clear sign that the cross-selling is working. And a big problem I see is that when people look at SoFi, they don't look at it as a software, but rather as a lender. And lenders don't really command high multiples. And traditionally speaking, SoFi was found on student loan refinancing. As the CEO was having some interesting things to say in the quarterly report, we're not a student loan refinancing company. We're profitable, full scale digital bank, fintech platform with recurring fee revenue. And then I don't know if you guys caught this one, but during the Q&A discussion, the CEO noted that we're talking about student loans. If the government decides to sell their student loan portfolio, we'll dig into it. It would be a great customer acquisition tool, not to mention the fact that we can make a significant profit on that portfolio of assets. With SoFi coming in and absolutely pulverizing, destroying earnings this year, I mean, it makes you think, are they going to be added to the S&P 500? And I think so. I mean, they have a strong chance, in my opinion, potentially as soon as the next rebalance in December or even early 2026. It's already checking most of the key eligibility boxes to be included, and its explosive growth in 2025 has positioned it as a prime candidate for the index committee's consideration. So I always think it's good to kind of check out what the analysts who follow the company think of it. I mean, they don't really leave their desks too often. They're focused on one industry. They usually have pretty good insight and they like to be conservative. So looking at some of them, I pulled here, what about seven of the most recent, going back to September. We don't have any re-ratings as of today. I'm sure we'll be seeing them coming out in the next week or so. But right here, we have a couple big names. You can see JP Morgan, Goldman Sachs, Morgan Stanley. They all follow the stock. And if you take a look, basically all their price targets are in the mid to upper 20s here, with a couple in the $18 range. And as of today, the stock's trading at $31. So, even with using analyst consensus, we can do our own DCF and see. But we'll get more into it in the next two slides on looking at the multiple and historically where it's been. I mean, I love the stock. I own a significant portion. I got in about 2 years ago. I just right now I don't think it's the greatest time to buy. I think the stock's a little ahead of itself, as I said earlier. My next slide, we'll see how what some people have to say when you compare it to traditional lenders like a JP Morgan, a real financial institution that's priced like a financial institution instead of software. Just things to consider. So I just thought this was a good point that Nancy brings up here. SoFi's priced like software, but in reality is built like a lender. They trade at, I think now it's like 75 times earnings, and JP Morgan trades at 16 times earning. The market thinks credit cycles don't exist anymore. SoFi will be completely okay. In my opinion, yes, they are priced like a software company, but I also think they're vastly different than JP Morgan. I don't think they should have as high as a multiple as they have now, but I certainly do think, and I disagree with Nancy, that they should kind of command a lower multiple, but still something higher than traditional banking. So I pulled up a chart here of SoFi's valuation metrics looking from 21 through 2025. And I wanted to do so to kind of give you an idea. We all know the stock has grown tremendously since 2021 to 2025, but to kind of put that in perspective, in 2021, it was trading at 9 times sales, which was pretty expensive. And it was trading at 8.8 times free cash flow for a yield of about 11%. Fast forward today, and the price of sales is still 9 times. You can see it's gone down to 2 to 4. Then it started creeping up 2, 4, 6, 9. Um, you know, I think it's starting to get overpriced. I mean, especially look at the price to earnings multiple here. Negative for those first 2 years, and then they're hitting 65 times, 73 times, 72 times. I mean, this is very much priced for perfection, and I'm not saying the stock can't go up here. I'm just saying from a valuation perspective, the company is performing very well, but it is expensive. It reminds me of a quote I once heard. You don't need an analyst to tell you when 10 times price to earnings multiples cheap, but you do need an analyst to tell you when 72 times price to earnings cheap. So, I mean, really look into it, do your research. I think the company has a lot to offer. You can see things going around on Twitter with some of the recent hires they've made, and their LinkedIn page is kind of alluding to more of an AI play moving into SoFi, which could be interesting. But at these price levels right now, it's trading at its lowest free cash flow yield in 5 years, and the price to earnings ratio is pretty inflated. I get they smashed earnings. I get they've been doing great, but if I didn't own a position and was about to buy, I don't know if I'd be buying in at these levels. I'd probably be waiting for a dip. But if you do own this stock like I do and have been holding it for a while, I don't think it's time to sell. I'd give a hold rating. So that's it. That's all I had for you guys. I think SoFi is an awesome stock, but right now I'm not buying. I'm not selling. I want to hold. Let me know in the comments what you think and what you would do. And as always, I hope you learned something and got something out of this. So see you next time.